All right, welcome back to The Explainer. Today, we're putting on our forensic accounting hats to dig into the draft red herring prospectus for Horizon Reclaim India Limited. Our promise for this explainer is simple. We're going to look entirely past the marketing hype, ignore the glossy brochures, and cut straight through the broad market narratives. Instead, we're going straight to the raw data to unpack the actual, underlying financial realities of this business, page by page.
But right off the bat, before we get into the numbers, we've got to lay down some strict ground rules. This video is purely for educational purposes and does not constitute financial advice. Please consult a SEBI-registered advisor before investing. We are here to analyze the data objectively, not to tell you what to do with your portfolio.
Okay, so here's our roadmap for today. First, Horizon's core business model. Second, tracking the IPO money. Third, a forensic financial deep dive. Fourth, risks and red flags. And finally, valuation metrics and summary. Let's dive right in.
Section 1. Horizon's core business model. What is it they actually do?
Well, at its core, Horizon Reclaim operates in the industrial recycling space. They run a manufacturing facility up in Roorkee, Uttarakhand, where their main gig is converting waste rubber into usable industrial products. Specifically, we're talking about reclaimed rubber and rubber crumbs, which they ship out to both domestic clients and export markets. But what's really fascinating is that more recently they've started generating an entirely new stream of income through extended producer responsibility, or EPR credits. We'll touch on why that matters in just a second.
When we break down their fiscal year 2026 data, you get a really clear picture of what's driving the cash flow. Reclaim Rubber, WTR, is bringing in the lion's share at just over 35%. That's followed by their Quals 2020 at nearly 20% and their Fine Grade at 6%. So there is some solid product diversification happening here. But don't forget those EPR credits we just talked about. That segment brought in over 310 lakhs in FY26. It's a really interesting, regulatory-driven income stream that runs right alongside their physical manufacturing operations.
But here's a metric that really caught my eye. While the company's overall revenue has been growing pretty rapidly, their percentage of repeat customers is actually trending slightly downward. In FY24, about 55% of their customers were repeat buyers. By FY26, that number dipped to just under 50%. As an objective observer, you kind of have to ask yourself, in a business that sells industrial commodities, what does hovering around a coin flip repeat customer rate mean for long-term stability? Honestly, it suggests a really high reliance on constantly hustling for new clients just to feel that top-line growth.
Moving on to Section 2, tracking the IPO money. Where are the funds actually going?
What's really interesting about the structure of this IPO is that it's a 100% fresh issue. There is absolutely zero offer for sale, or OFS. That means the existing promoters, Mohit and Malika Bajaj, aren't using this as a liquidity event to cash out their existing shares. Every single rupee raised from this up to 52.69 lakh share issue is going directly onto the company's balance sheet. Nobody is heading for the exits just yet.
So how are they spending it? Well, out of the total issue proceeds, a massive chunk, up to 2,670 lakhs, is dedicated purely to paying down existing borrowing. Only 943 lakhs is going toward capital expenditure for new machinery, and another 600 lakhs is earmarked for working capital. When you analyze the spread, it's pretty clear that this IPO is heavily focused on deleveraging the company's balance sheet, rather than being a pure-play, aggressive growth raise.
All right, Section 3. This is where it gets fun. The forensic financial deep dive. Let's look under the hood.
Taking a close look at their 3-year trend, the top-line revenue growth is undeniably aggressive. They jumped from 2,032 lakhs in FY24 to over 4,942 lakhs in FY26, so they've more than doubled their revenue in a really short time frame. But look at the profit after tax, or PAT. It completely exploded. It went from a modest 71 lakhs in FY24 to a staggering 1,050 lakhs in FY26. That is nearly a 14-fold increase in net profit for a business whose revenue only slightly more than doubled.
And their margin expansion tells us exactly where that profit is coming from. Their EBITDA, earnings before interest, taxes, depreciation, and amortization, jumped from roughly 117 lakhs in FY24 to over 1,632 lakhs in FY26. Now, as a forensic analyst, whenever you see margins expanding by the sheer magnitude directly in the 18 to 24 months before an IPO, you've got to ask why. Was there some massive technological breakthrough? Did raw material costs suddenly fall off a cliff? Or Is the company just operating at peak, unrepeatable efficiency right as they prepare to go public?
So the crucial point here is understanding the vital difference between accounting profit on paper and actual tangible cash. Let's take their FY25 numbers, for example. On paper, their profit after tax was an impressive 706 lakhs, but their actual cash flow from operations was only 171 lakhs. That's a huge gap. It likely means cash is tied up in inventory, or maybe they're increasing debtor days as they stretch their working capital cycle. Basically, a significant portion of their paper profits isn't actually sitting in the bank as cold, hard cash just yet.
Which brings us to Section 4, Risks and Red Flags. Time to check for structural vulnerabilities. Here are a few specific stated vulnerabilities from the prospectus that you absolutely need to be aware of. First, the intended use of the IPO funds is entirely unappraised by any independent bank or financial agency. Management has a lot of flexibility in how that money actually gets deployed. Second, they're dealing with a pending GST order demanding roughly 8.5 lakhs. It's not a massive sum, but regulatory friction is always a metric to watch. Third, the business has high working capital requirements that are heavily dependent on financing. And if you dig into the disclosures, you also have to monitor the related party transactions just to ensure that any deals with promoter-linked entities have clear commercial justification.
Finally, Section 5, Valuation Metrics and Summary. Let's get to the final verdict.
Let's look at how the company's returns on equity have evolved. Their return on net worth was a modest 10.3% in FY24. Then, it spiked dramatically to an incredible 65.47% in FY25, before cooling down just a bit to 53.63% in the most recent fiscal year. This ties directly back to that massive EBITDA expansion we noted a minute ago. The underlying equity is doing a lot of heavy lifting right now, but the lingering question is whether that 50+% return rate is actually sustainable in the long term.
Next up is a pre-issue debt-to-equity ratio of 1.44. This means they currently carry a pretty significant amount of debt relative to their equity base. And honestly, this perfectly contextualizes why over 2,600 lakhs of the IPO funds are earmarked specifically for debt repayment. They are using the public markets to deleverage a relatively debt-heavy balance sheet. Post-IPO, that move should significantly improve this ratio and take a big bite out of their interest burdens.
But there's a missing puzzle piece here. Because this is a draft red herring prospectus, the final issue price hasn't been set yet. That means the price to earnings, or PE ratio, is just a placeholder for now. Without that final price band, retail investors have to rely heavily on the historical metrics we've just covered to determine if the eventual asking price is fair when compared to their industry peers.
So what does this all mean? We've seen a company with explosive top and bottom line growth, soaring margins directly preceding their public listing, and a very clear plan to use public funds to deleverage their balance sheet. But on the flip side, we've also seen a real disparity between paper profits and actual operating cash flow, dropping repeat customer rates, and entirely unappraised fund allocation plans. So weighing the subjective, hard data against your own personal investing strategy, does Horizon Reclaim fit your portfolio's risk appetite? Well, that is a question only you can answer. Thanks for joining us for this explainer, and remember, always keep your eyes on the data.